A market crash is coming whether we like it or not. There was a survey released this week by Deutsche Bank on 657 financial professionals, and 89% believe that there's a financial bubble at the moment. Now, these guys could be completely wrong, but it's kind of hard to disagree with them because interest rates have been near zero for as long as I can remember. There's companies that have never posted a profit, seeing their share prices soaring. There's IPOs hitting the market at 3 times their target price. There's been endless money printing, and we still don't know what the full damage of COVID has done to the economy. Oh, Master's just scaring myself there as well for a second. Sorry about that. Even if a market crash is a long way away, market crashes are a very normal part of investing. All you have to do is do a simple Google search. Trust me, it's a very, very long list. This is why it's vitally important that we actually prepare for these market crashes and set your portfolios up so they can ride them.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule. And that's all the rules there are.
That was the great Warren Buffett showing us what we really should be focusing on. Welcome to the Hedge Startup. My name is Walter Dunphy. On today's video, I'll be showing you a few very simple strategies that you can employ for your own portfolio that will help you reduce the risk of losing your money basically in a financial crash. Okay, so the first thing I need to explain to you guys is the VIX index, aka the volatility index, aka the fear index. This index has been around since the 90s, and basically what it tries to do is predict the amount of volatility that will be on the S&P 500 in the next 30 days. I'll show you very shortly why volatility is a very important indicator when it comes to market crashes. I won't get into the technicalities of the formula behind the VIX index, but basically it is averaging the weighted prices of out of the money puts and calls. That's something you don't have to worry about and never think about it again. What you really need to know is that stocks go down 10 times faster than they go up. So once there's a bit of a dip, people are afraid of losing their money and they start to sell straight away. And this causes a real big spike in volatility. Here's the chart for the last 12 years. Whenever there's a huge sell-off, a crash or a market correction, the volatility index has a massive spike to the upside, as you can see here. Now I'm going to talk about how you can use this index to your advantage. There are ETFs that basically track this index, and they're a great way of hedging your portfolio against any market crashes. Okay, so now I'm going to show you a specific example of how it would have worked if you had incorporated a VIX ETF into your portfolio in early 2020, just before the coronavirus crash. So firstly, I'm just going to show you a little summary here of how the VIX has performed against the S&P 500 during the last 3 market crashes. So the VIX is an American ETF. So I'll talk to you about a European option after this example. But let's just see here. So for the last few market crashes, as you can see here, whenever there's been a crash in the S&P 500, the VIX has really rocketed up in price. So as we can see here in February 2020 to March 2020, the S&P crashed 35% and the VIX went up 479%. So for this specific example, I've taken this data from the Wealth Insider. So I have 2 separate portfolios here. One is just 100% an S&P 500 ETF, and the other is 10% in the VXX ETF and 90% in the S&P 500. So you see here 9,000 and 1,000. And the 10,000 here is the 100% in this S&P 500. So just before the crash in 2020, so around the 19th of February, the portfolio that was 100% in the S&P 500 would have had around a return of 4.6%. When you compare this then, somebody who had 10% in the VXX and 90% in the S&P 500, they would have been slightly worse off. They would have had 3.4%, but not much of a difference. The 23rd of March comes and there's a massive crash in the market. The person that's 100% in the S&P 500 is now down 31%, which is a huge, huge fall. But as you can see, the person who has 10% in the VIX ETF is only down 6.7%. That is because the VIX ETF has gone from 925 in February up to 3,122. So your strategy after this then is once the VIX reaches its heights, you're going to try and time it so you get the most value out of it. So at that point, what you would do is you would sell your holding, your 10% in the VIX ETF. And with the proceeds, you would rebuy into the S&P 500. So as you can see here, as we move to the 24th of March, we're completely all in the S&P 500. So we're the same now as the portfolio 1. But obviously now we have a much higher value. They're down 31%, we're down 6.7%. And in the 3 months after that crash, the S&P 500 rallied again. So as you can see, portfolio 2 grew then to 12,877, whereas Portfolio 1 is still down 4.6% overall. And we in Portfolio 2 are up 29%. We've come out the other side of a market crash. Okay, so the most important lesson really from that strategy is that timing really is everything. So you need to really time when that VXX index hits its peak. So a good way of doing that might be just when it's starting to rise, you might just sell a little portion of what your holding is, and then as it rises further again, you might sell another little portion, just so you don't really mistime the market altogether. So for my example, the ETF that I was using is based in the US, or domiciled in the US. So now I just quickly want to talk about an option that would be available to EU retail investors. So I just have two charts here that we can take a look at. The ETF that I was using in the example above is the VXX, as you can see that chart on the left there. And we also have one in the EU, and it's called the Lixer S&P 500 VIX Futures Enhanced Roll Uses ETF. So the ticker code for that is the VOOL. So these charts are covering the last year, and as you can see, the two ETFs have been pretty much in sync with each other. They've peaked and troughed pretty much at the same time. So for anybody in the EU, that might be a useful one to have a look at. So quickly, I just wanted to talk about another little strategy that might help you out to offset any losses that you can make during the market crash. Is to incorporate stop losses into your portfolio. So stop loss, it will sell off your stocks when the price hits a certain level. So it really limits the amount of losses that you can really take on. So that could be something you should also look into to help you out. Now, this is not financial advice, so it's important that everybody looks into this themselves. I just wanted to show you how some investors have successfully hedged against market crashes in the past successfully using this strategy. So I hope you enjoyed the video and you found it some way useful. If you did, make sure to subscribe to the channel, and I would really appreciate it as well if you hit that little like button. And I'll see you guys again soon.